Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks slipping here. Investors are juggling the latest round of corporate earnings, persistent trade tensions, and clues as to whether the Fed will be more aggressive with rate cuts. We're going to be digging into all those stories. But right now, there's just an hour to go until the closing bell, and stocks are lower. Let's take a look at the major averages. We have the Dow is down about 290 points. The S&P 500. Your broad gauge is down about 0.7%. Your tech-heavy NASDAQ is down about 0.6%. Let's welcome now our data and markets editor, Jared Blickery. Jared, what are you seeing in today's trading action so far?
I'd call this a moderate sell-off, and let's just look at the moderate sell-off in the Dow right now. And this is the intraday price action. Started out in the green, drifted into the red, just off of the lows, which we hit after the 2 p.m. hour. In the NASDAQ, we're down about the same amount, 0.6%, also off of the lows. And the S&P 500, also a similar chart. So we started off the day all right. Then what happened? Well, we got some news out of two regional bank reports this morning, and some interesting things to get into. I'm going to show you the regional banks in a minute. I just want to show you what's happening with the VIX. Now, the sell-off that we're having today is not anywhere close to what we saw last Friday on the China tariff scare, yet the VIX is up more. It was up about 20-21 on Friday. It's about 24 right now. And this is the season when you tend to see the VIX spike. And this is October VIX seasonality at work here. Here's the VIX of the VIX, 131. And I want to skip on down to the bond market because the 10-year T-note yield has cracked 4%. We have not seen a low like this since April, and it was very brief in April. It was after Liberation Day. Very quickly, it rebounded up, but now it's at 3.98%, down 7 basis points. And if I show you a year chart, looks like it's on track for maybe one of the lowest closings in a year. I haven't seen a yield like this on a sustained basis since last October. That would be before President Trump was even elected. Here's the 30-year down 5 basis points to 4.59%, and the U.S. dollar index also, let's put an intraday on that, that is lower by about 0.4% as well. And I'm going to start out with the regional banks because this was the source of the trouble. Two banks here, Zion, which is down 13% today, and also Western Alliance Bank, and that's about down 10%. Well, I got a lot of banks on here, so there we go, down 11% right now. There were some credit scares, and so I think the thinking is this part of a larger credit issue within the banking sector? Might be feeding into the rate cycle, might be feeding into recession fears, but that's getting way ahead of ourselves right now. We don't want to put the cart before that horse. And let me just back it up and show you the sector breakdown right now. Everything's in the red, but financials leading the way down, not surprisingly, down about 2.7%. Energy, the second worst off. Then communication services and consumer discretionary, all those down more than 1%. Give you a quick look at the NASDAQ 100, and you can see, aside from NVIDIA and Alphabet, we got a lot more red than green here, not a lot of dark red. I would say a lot of the selling that we're seeing is really concentrated in the financial sector. And then you see in the Dow here, you got some relief spots, but those are kind of the safety trades like Johnson & Johnson, Procter & Gamble up 1.5%. And then I'll just show you some green, some green here. We do see Micron up 5%, and then in tech also we got Oracle and CRM, that's Salesforce, up about 3 and 4%. Back to you.
All right, thank you, Jared. Well, Federal Reserve Governor Chris Waller saying he's in favor of trimming interest rates at the end of this month. Yahoo Finance's Jennifer Schonberger joining us with the latest. Jen.
Hey there, Josh. That's right. Fed Governor Chris Waller saying that he favors cutting rates by another 25 basis points at the end of this month. But after that, he wants to take more of a cautious approach, implying that he may want to hold rates steady and wait and see depending on how the data comes in. Waller saying that right now we have conflicting data telling a mixed picture. On the one hand, you have weaker job data. On the other hand, you have strong economic GDP growth. Waller saying in a speech earlier today in New York, quote, something's gotta give. Either economic growth softens to match a soft labor market or the labor market rebounds to match stronger economic growth. Since we don't know which way the data will break on this conflict, we need to move with care when adjusting the policy rate to ensure we don't make a mistake that will be costly to correct. And of course, the government shutdown is complicating the picture for the Fed. They don't have that all-important September jobs report, nor do they have retail sales. And inflation data has been delayed as a result of the shutdown. They're not going to get that until the end of next week. As a result, Waller says he is relying on contacts on the ground and private sector data. And given what he has seen and heard, he thinks that the job market has deteriorated over the past month or so. At the same time, he says consumer spending appears to have held up from retailers he has spoken with. Now, Waller's words of caution come just after President Trump's newest appointed Fed Governor Stephen Miron said that he wants to cut rates by 50 basis points at the end of this month. He thinks that renewed trade tensions pose a risk to the economic outlook. Myron's less concerned that tariffs are going to contribute to inflation, and thus he wants to get to a level of neutral on interest rates. That's a level that's designed to neither spur nor slow growth faster than his colleagues. And this emerging division amongst the doves on the Federal Open Market Committee comes as Waller, who seemed to be that leading voice for cutting rates going as far back as this past summer, now appears to be sort of stepping back a bit from that stance, just as he is on the short list of Treasury Secretary Scott Bessent's consideration to be the next Federal Reserve chair. Josh?
And Jen, while we have you, we got new data on the U.S. deficit this afternoon. What do we know?
That's right, Josh. The U.S. deficit actually fell the U.S. deficit was nearly $1.8 trillion, or $41 billion, or 2% lower from fiscal 2024. And that deficit to GDP number fell to 5.9% from 6.3% for fiscal 2024. That's thanks to a 6% increase in receipts, but also a 142% increase in customs, the bulk of which comes from President Trump's tariffs. So the U.S. collected nearly $200 billion in tariffs for the fiscal year ended September 30th, 2025. Now, interest on debt hit a record for another year. That was up $83 billion, or 7% higher, to $1.2 trillion for the fiscal year. Meanwhile, for the month of September, the U.S. clocked a monthly record surplus of $198 billion. That's nearly 150% higher than last year, thanks to higher tax collections and record tariffs. At the same time, though, corporate tax collections were down 41% because of changes in the new tax bill that allow corporations to take deductions. Josh?
All right, thank you, Jen. Well, the U.S. 10-year dipped below 4% in today's trade. Let's get more on the bond market. We got Kelsey Barrow, fixed income portfolio manager at JP Morgan Asset Management. Kelsey, it is great to see you, especially today. Your timing is impeccable because we need your thoughts on this benchmark 10-year. It slides below 4%, Kelsey. That's the news today. That's what's getting attention. I'm curious what you make of that. What explains that? Is this investors getting nervous about the shutdown? U.S.-China trade tensions? How do we explain this?
Yeah, so 4% is a critical level for the 10-year Treasury yield. It's a level that we've tested probably 4 or 5 times in the last 12 months, but have not been able to trade materially below it for any period of time. So I would be watching to see if today at the close, we still manage to stay below 4%. Now, it looks like we are going to hold, but obviously there's a little bit more time in the trading day. Now, the bid to Treasuries and the demand for Treasuries today really picked up as we saw some of the negative headlines and concerns around the regional banks. The correlation was pretty high between the move in yields and the KBW index, which is
that's what you
the
would pin it
regional
on.
bank index.
Yeah.
Well, a little bit. Certainly there was a flight to quality bid. Now, as a fixed income portfolio manager who's lived through some other economic cycles where bonds didn't always do as well in a risk-off period, what I would say is that I am happy at least to see that bonds are performing the way that I would expect within the portfolio, meaning that when you do have a flight to quality, you have a fall in equity markets, you're seeing treasury yields fall, treasury prices rise. That anti-correlation is why investors tend to want to have some fixed income in their portfolio as a ballast. So you are seeing that traditional relationship, negative correlation between equities and bonds reassert itself because of the concerns around credit and around growth.
But it has to stay below 4% for some period of time, Kelsey, before you would assign it too much weight? Is that what you're saying?
Yeah, because what we've seen is that despite the fact that there have been, concerns around the labor market. There's been some concerns around credit quality that is coming up today. More broadly, the base case assumption, I would say, within the rates market is that, we're still in a sub-trend growth environment. The economic expansion is going to continue, and therefore, while the Fed is cutting rates to support the economy, they don't need to cut rates very aggressively or very materially below neutral to respond to a recessionary environment. This is still an economy that is doing well, and interest rate cuts may be necessary, but not extremely aggressive ones. And that was really the debate that you were hearing in the segment before about you had Waller on one side who's calling for rate cuts but calling for gradual ones versus Myron, who's more in the camp of larger rate cuts more quickly.
Can I ask you, Waller brought up this interesting divergence, because what he's saying is GDP is hanging in there, but the labor market's cooling. I'm wondering how you would think about that divergence and whether you think it continues.
Yeah, so I have seen that divergence, and I think there's a couple things that explain it. I think the first thing to highlight is that from the Fed's perspective, their dual mandate is price stability and maximum employment. So they're going to be naturally more focused on the labor market signal than they are on the growth signal. Now, in terms of the divergence, I agree with Governor Waller that it's probably not a divergence that can last forever, but I do think one of the areas that has been resulting in that divergence is the business investment within the AI sector. So if you were to take that investment out, growth would look much more in line with the labor market data. So I think some of that disconnect is a function of growth being somewhat concentrated in just a few areas, and particularly the emphasis in the first half of the year has been that business investment in terms of AI and software, which is overwhelming some of the weaknesses in the rest of the economy.
I thought I was going to get through a segment without mentioning AI, but there it is, Kelsey, right at the end. Always great to see you, especially today. Thank you so much.
Absolutely.
Well, coming up, homebuilders starting to feel a little more optimistic. We'll speak with the head of the National Association of Home Builders and find out why. Plus, you may be able to level up your gaming game. Microsoft is integrating AI technology into Xbox and its Windows platforms. Our tech editor joins us with all those details. And the U.S. and the U.K. ramping up pressure on India to cut Russian oil imports. But what will that mean for prices? Those stories and more coming up. Homebuilder confidence gets a boost as future sales expectations jump in October. This comes as mortgage rates edge lower. Here to decode the state of the housing market, let's welcome in now National Association of Home Builders CEO Jim Tobin. Jim, great to see you as always. So let's talk about these numbers. So builder sentiment, it did rise here, better than expected. 37, Jim. So we're below that 50 mark there. Future sales expectations did surpass 50. I just want to, maybe help me walk through these numbers and the trends. I did see, bottom line, your chairman saying here, the market remains challenging. Is that how you see it, Jim?
I do. I think the market is extraordinarily challenging at the moment. But the good news is that forward-looking sentiment, I think there's a real optimism with the builders right now about what the next 6 months are going to hold. I think that has a lot to do with interest rates coming down over the last month and mortgage rates in particular. The Federal Reserve lowering rates with the prospect of maybe one, if not two more cuts coming before the end of the year signals some reason to be optimistic about where the housing market is settled. That said, mortgage rates are still a long way from what hopefully is the new normal. normal, somewhere inside that 5% handle. So we've got some challenging times ahead with buyers trying to get off the market, get into the market, get off the sidelines. So I think we still have some bumpy roads ahead.
Jim, the 30-year fix, according to Mortgage News Daily, I'm just looking here, 623. You've got economists on staff there, Jim. Where do they see that headed from here? 12 months from now, what are they telling you?
I think for over the next 12 months, we're going to be probably about the same place we are now. Just given that we still have some economic uncertainty out there, where the Federal Reserve takes us, does unemployment rebound? Does inflation stay, on that downward trend, or at least stay, kind of firmly in that 2% range? That's the real challenge in front of us. But I think the mortgage rates are going to trade in a kind of a narrow band between 6 and 6.5. Between now and the end of the year. We really don't predict kind of consistently into that 5% range until we get into 2027.
What have we been seeing with pricing, Jim?
A lot of discounts being offered by builders to move product. As builders stay on the sideline, there's a lot of reports that out there that this is a buyer's market. We are seeing that deep discounts are the order of the day. Some mortgage rate buy downs, but we're hearing that price reductions in the home itself is really what's moving the market in the areas that it can.
When you're talking to builders, Jim, across the country, I'm curious, and maybe you ask them, hey, what are your most significant challenges right now? What are your most significant headwinds? Are there certain themes, Jim, they bring up? Is it labor? Is it materials? Is it red tape? What do they tell you?
Yeah, I as you know, Josh, I travel all over the country. I've been in Iowa, Oklahoma. I'm currently out in the Pacific Northwest now. So I talk to builders all over the country. Consistently, it's about high mortgage rates, getting buyers off the market, and it really still always comes down to the red tape at the local level. What barriers are local governments and NIMBYs putting in the way of builders to build more supply right now? So again, interest rates, but then that local, the delays and costs it takes to build homes in this country, it doesn't matter what market you're in, continue to be one of the chief complaints of builders.
Does the federal government, Jim, have a role there to play?
Absolutely. I think the federal government, they are part of the regulatory regime. You've heard me say this before on your show. 24% of the cost of a home in this country is embedded in the regulatory burdens at local, state, and the federal level. So the federal government does have a role to play. Certainly, we talk to President Trump, his White House, as well as his departments and agencies all the time about some of the deregulatory actions that he can take to lower the cost of land development and construction in this country. And then what are the levers that the federal government can use to put the onus back on local governments to remove those barriers to housing production in the country? And so we're expecting some action with the administration. There's a bill working its way through Congress. The road to housing right now, it's moving through the Senate. The House is going to act. So housing is having this moment, and we've got to translate that kind of political moment into a policy moment in the country.
Now, Jim, you mentioned President Trump there. You saw his comments calling on Fannie and Freddie to boost home building. What did you make of that?
Well, we share the president's absolute desire to increase the housing supply by building more housing in this country. Certainly, Director Pulte shares that view. We've talked to them consistently, not only since the president tweeted about a week and a half ago, but since the director was confirmed and the president came in January. So I believe that there is a role for Fannie and Freddie. Obviously, they do a great job on the mortgage side. But if we can hold the feet to the fire of local governments and work on regulation to, again, get those barriers out of the way, what role can Fannie and Freddie play as far as when it comes to construction lending? We continue to talk about a way that they might be able to do that. But what we really need to do is make sure that everybody, all the builders out there, all we want to do is build housing. We want government to be a partner and not a hindrance. And so when I hear the president and Director Pulte talking about building more housing, that is music to my ears, and we are ready to go.
Jim, always good to see you. Thank you, sir.
Thanks, Josh.
Well, Microsoft take another big plunge into AI, making it central to the PC experience. For more, we're bringing in Yahoo Finance tech editor Dan Howard. Dan.
Yeah, Josh, this is a new update for Windows 11. Basically, we're at the end life for Windows 10. They're just ending the service, so they call it end of service, not end of life. You can still use Windows 10, but you're not going to get security updates, things like that, or you're not going to get major feature updates, rather. This is a major feature update, and what it does is it essentially starts to set up this idea, as Mustafa Suleyman, the Microsoft AI CEO, said, of AI as the operating system. And so you'll be able to do things like talk directly to your computer. You don't have to necessarily type. You can if you're in like a coffee shop, sitting at Starbucks, talking to your computer might be weird, but if you want to, you can still. And it allows the computer to see what you're doing if you give it permission. So say, for instance, one example Microsoft lays out is if you're listening to Spotify and you want to improve the audio quality, you could say, you're speaking to Copilot, Microsoft's Copilot, you say, hey, Copilot, how can I get better sound quality out of my playlist? And it'll literally look at your screen and then circle the area for audio quality in the Spotify app and tell you to go there and do that. It's being used across different apps, different capabilities. There's a test feature where it'll be able to take advantage of actually performing different tasks for files stored on your laptop or desktop. So if you want to bulk rename images, it can be a pain, or you want to get rid of duplicate images, you could say, hey, Copilot, get rid of duplicate images in this folder, and it'll do that. So it's how do I install a printer? The bane of everyone's existence, and probably will be something that you have to do if you're the IT person in your family like I am when you go home for Thanksgiving. So it'll be able to kind of take care of that, get rid of those unnecessary, I guess necessary evils, but take care of them for you. And so it's a big change. One last thing I just want to mention is they also are rolling this out for Xbox and the gaming side of things. So, if you have a question about a game, you're stuck, you don't know how to do something, you just want to learn more about it, you can literally ask your Copilot and it'll tell you information about the game. So it's going across all these different services, Microsoft 365, the Windows 11 itself, and then the Xbox. So it really is just showing how much Microsoft is spreading this technology across their devices. We just have to see how consumers pick that up and what they kind of do with it. But I think this is a good move as far as using AI for your devices, especially if you don't have to install a printer. My God.
It is remarkable in 2025 how much talk, even in the Lipton household, goes on about the printer, the frustrations with the printer. But let me get this, switching gears, because I saw this headline. I thought I might get Dan Howley's take on this. Bloomberg, I think it's Gurman, reporting that Meta poaching the Apple executive who was leading the effort, in fact, Dan, to develop AI-driven web search. What do you make of that?
This would have been part of Siri where it would be able to pull from the web, right? And so, Apple's still going to be working on this, but is this a big loss? Yes. Apple has been losing executives to competitors for a few months now. And it's part of the regular rigmarole of Silicon Valley and the tech industry. You go here, then you switch over and go there. Oh, these guys are going to pay me more now. Well, now they're going to pay me more. But for
some
Apple,
of the pay packages, by the way,
millions of dollars, for
like NBA All-Star money.
Yes, yes. Yeah. But it's one of those things where, how many times does Apple have to go through with this? And what does this do as far as its new version of Siri and its Apple Intelligence capabilities? And I think that's obviously something on Wall Street's mind. Do I think that people aren't going to buy iPhones or Macs because they don't have the latest and greatest AI capabilities? Not yet, but as we start to see it permeate throughout the systems, there's no one app that's going to do this, right? There's no one app that's going to say, gotta get it, gotta switch from my iPhone. But as we see, with Microsoft and Android, AI go throughout the operating system, right? That's where I think, people say, well, how come Apple doesn't have that? And they will, and I just want to point out this last thing. People were still using iPhones when you couldn't copy and paste stuff. I remember I was listening to the news radio, because I'm ancient, and they announced it on the news that copy and paste is coming to the iPhone. It was on Android for a while already.
Right.
So people are going to stick with it.
Dan, thank you, sir. Appreciate it.
For sure.
Coming up, what can Americans expect when it comes to oil and gas prices? We're taking a deep dive into the commodities when we return. Oil prices continue to slide today. They had initially risen after President Trump said India agreed to halt Russian oil imports. Senior reporter Inez Frey is here to help break down the action. Inez.
Yeah, Josh, and just as you said, we first saw oil prices jumping after President Trump had said that Prime Minister Modi of India had assured him that India would stop buying Russian oil. And keep in mind that Russia is India's top supplier. But then India came out with comments basically not saying anything about what Trump had said and basically saying that their main goal is to assure energy price stability and making sure that they have supply. So then Trump this afternoon also had tweeted out on Truth Social, put out a post saying that he had had a phone conversation with Vladimir Putin of Russia, calling those talks productive, saying that Trump will be meeting with President Zelensky of Ukraine tomorrow at the Oval Office. Now, keep in mind that there have been sanctions on Russian oil. So if you suddenly have Russian oil that can flow freely, this would bring down prices. And that's really why we saw prices declining this afternoon. You saw WTI down more than 1%. Brent crude also lower as well. And this has been one of those components of the supply, world supply, Russian supply, and also OPEC Plus, which has been increasing supply as well. So you've had Wall Street warning about an oversupply, in part because OPEC has been increasing its supply as it wants to increase its market share of the oil market. So right now, look, if we are looking at year to date, we're looking at WTI that's down more than 20% year to date. It's actually down at the May levels right now. We saw a spike back in June during that U.S. strike against Iran, but it has been on a downward trend since then. Brent crude also down 19% year to date. Wall Street is expecting prices to go lower going into next year as that oversupply comes into the market. Josh?
Thank you, Inez. Well, as oil slides, so do gas prices. And Yahoo Finance caught up with Gas Buddy's Patrick DeHaan on what's driving the lower cost at the pump.
Americans simply not driving as much as temperatures start to cool off. We've also seen the transition to cheaper winter gasoline in 49 of the nation's 50 states. In addition, the price of oil falling below $60 a barrel for the first time since 2021. That really having to do with potential trade war or tensions between the U.S. and China. So all that seasonality now enhanced by decline in oil prices, and also OPEC continuing to raise oil production, giving certainly a very healthy dose of falling gas prices. In fact, some areas of Oklahoma now just 10 cents away from seeing the first station below that $2 a gallon mark. We certainly expect the $3 a gallon mark will be broken here in the next few days.
Wow, below $2. Amazing. Okay, so we're going to go sub 3. How long do these cycles normally last? How long could good prices nationwide, the average price, be below $3 a gallon?
Yeah, Julie, this is something that will probably stick around for a good portion of the winter. Now, if it's a normal year, gas prices tend to bottom out between Thanksgiving and Christmas. So that may give us another 2 to 4 weeks of declining prices before prices then will start stabilizing at some of those lows until maybe January, February. And that's when gas prices start to tend going up. So they should be around these low prices through the holidays.
What about this sort of the latest headlines with President Trump talking about India no longer buying oil from Russia, that having some effect on the market? You know, whether it's that or some of the other geopolitical events, are there a lot of upside risks to oil prices?
I mean, there's certainly upside risks. You mentioned India, another one, China, right? President Trump has been trying to persuade both of them from not buying Russian crude oil. And that's been the imperative part of this market, is that Russian oil, as long as it makes it into the market, that additional supply that Russia exports is helping to keep prices low. So if something were to change there, if India were to stop buying Russian oil, that simply means that Russian oil is not going to have a place in the market. That supply loss then could contribute to higher oil prices.
And what about regional differences around the country, Patrick, that I know you track closely also?
Yeah, Julie, I mean, you had that map up there. Wide disparity in prices. California is still $4.65 a gallon. And on the other side, station in Oklahoma down to $2.09 a gallon this morning. So a lot of regionality, and motorists in those states, I mean, we're talking about less than 2,000 miles with a $2 a gallon difference. California continuing to have the nation's highest gas taxes. They have CARB mandates, rules and regulations keep prices much higher in California. So, it always pays to shop around. Certainly smart motorists in the Gulf, apps like Gas Buddy, Google Maps always can show you those huge price differences.
Now time for today's trending tickers. Yahoo Finance's Alec Canal. Joining me here for a look at Oracle, regional banks, and Tesla. We'll start off with Oracle, company providing margin expectations that seem to be easing some of the street's concerns. So this one, Ali, Oracle was making a presentation to investors at its annual conference there in Vegas. Larry Ellison's company, we know, has been making these deals, develop AI data centers with big names, OpenAI, Meta, XAI, and investors have had questions about what exactly that was going to mean for profitability, right? And so Oracle was kind of lifting the curtain there a bit, and investors like what they heard.
Yeah, like what they heard, and this has been a big issue when we talk about whether or not we are in an AI bubble, whether some of these assets are heading towards some of that bubble territory. But at least right now, we see that companies like Oracle are showing that, yes, the top line is there, but hey, the profits can be too. So in this presentation, they laid out that they're expecting margins in the mid-30s on a large multi-year project. Again, all around those GPU heavy data center build outs. In terms of the pecking order here too, when we look at other types of cloud businesses, this at least maybe narrows the credibility gap a bit. If Oracle can sustain these margins as scale continues to build, it does provide a stronger case against the big three, which we know is Amazon's AWS business, Microsoft Azure, and Google Cloud. So we'll have to wait and see if Oracle can actually deliver.
Yes, an AI infrastructure project with $60 billion in total revenue over 6 years. Just for example, they say have a gross margin of 35%. And I saw analysts cited saying that they thought that helped quell concerns about lower profitability.
Yeah.
All right, moving on, turning on to regional banks. Some of those stocks under pressure amid growing concerns on Wall Street. Jefferies, Zions Bancorp, among the names under pressure. Had an investor on today, Ali, saying in part she thought the news today, these headlines will help to explain why your 10-year benchmark slipped below 4%. Bloomberg has a good write-up here, noting you had two regionals disclosing bad loans tied to alleged fraud. You had Zions disclosing this $50 million charge-off for a loan underwritten by, I guess its subsidiary, California Bank and Trust, and Western Alliance, they point out, dealing with a borrower that failed to provide collateral loans in first position.
Right, and you mentioned yields, and that is immediately what stuck out to me. We now have the 10-year trading firmly below 4%. Typically, when you see that type of buying in the bond market, that suggests investors are anticipating slower growth, maybe even a recession, and it does seem to be stemming from these regionals. That's also why you're seeing the major indexes turn lower today. So just a fascinating story here. If you take a look at KRE, this is the regional bank ETF, that's been heavy on the losses today. I believe we're now down around 6% in afternoon trading. Now, you mentioned a few of those banks there. It does seem to be more idiosyncratic than systemic in nature, at least at the current moment. We're talking about a few troubled loans, some fraud allegations at individual borrowers, but investors are looking for possible canaries in the coal mine here, and they might have found it within these regionals. And of course, when you talk about lower yields, that's good over the long term, especially when we look at corporate buying, personal loan borrowing. But near term, there does seem to be some jitters around credit quality. So this is a story that I think we're going to have to watch closely and see how it plays out in the coming days.
Yeah, analysts at Stephens, I see cited saying there have been a number of one-off credit events that a number of banks they know have previewed going into the quarter, which has not gone unnoticed by bank investors, and that's for sure. Lastly, let's take a look at Tesla. BNP Paribas, they initiate coverage on that stock with an underperform rating, equivalent of a sell, Ali. What they say here is they initiate Tesla with an underperform. Yes, they are bullish on Tesla's future, but we still can't justify the stock's valuation. Target's 307.
Yeah, valuation right now is leaning very heavily on AI, robo-taxis, robotics, and that just doesn't really exist right now. It has zero revenue. And while the core auto business continues to face pressure here, BNP basically saying that they're not fully convinced that the stock is a buy right now. A $307 price target. Now, Barclays is more neutral, saying that fundamentals will will matter again as we head into earnings, which are October 22nd. So that seems to be the next possible catalyst here for Tesla. Earnings and any new details on robo-taxis, the product roadmap here. If there's no proof points, though, in AI or if auto margins disappoint, that valuation debate only gets louder and louder.
Yes, our Barclays' Dan Levy, they are saying well-positioned long-term, he says, but investors are overlooking near-term headwinds. All right, thank you, Allie.
Of course.
Well, coming up, Bitcoin is underperforming. We'll have more details after the break, plus a look at the digital asset landscape. Stick with us. Digital asset treasury companies are a growing trend in the crypto space. Yahoo Finance's Inez Frey breaks down what they are and how they work.
Digital asset treasury companies. So what are they and what do they do? This is what they are. A digital asset treasury, basically called a DAT, is a business that holds a large amount of digital assets like Bitcoin, like Ethereum on its balance sheet. And unlike traditional firms that hold cash or bonds, DATs raise capital through stock or debt, and then they deploy it to buy cryptocurrencies. Their valuations often move in tandem with the value of those tokens. So here's how they operate. First, they raise the money and then they purchase the digital assets, often Bitcoin, sometimes it's Ethereum, and use specialized custody security systems to manage them. And then they lend them, they can also lend those tokens out or stake them to generate extra yield. Their stocks trade at premiums or discounts based on the value of those holdings and investor sentiment. So who are the biggest players? Well, the giant in the space is Strategy, formerly known as MicroStrategy, led by Michael Saylor, the world's largest public company that's holding Bitcoin, the largest holding of Bitcoin. Other companies include Bitmine. You also have Mara Holdings, Metaplanet, SharpLink Gaming. These are some of the companies that have adopted crypto-heavy balance sheets. So in total, public companies now hold more than 1 million Bitcoin, roughly about 5% of the entire supply. So why the surge in interest? Well, first, you have institutional adoption that's accelerating from pension funds to hedge funds. More capital is entering the digital asset space. Also, you have regulatory clarity that's improving. That's making it easier for companies to hold and report digital assets. And many executives see Bitcoin as a hedge against inflation or just a more productive use of treasury cash. And finally, the market sees these companies as high beta ways to get crypto exposure without directly buying the tokens. When digital assets rally, their stocks rally, often soaring, but there is a warning. When crypto falls, the losses can also be sharp.
Well, Bitcoin feeling the pressure ever since President Trump's tariff threat on China triggered a sell-off. Now the corporate Bitcoin holder Strive, though, doubling down, agreeing to a merger with Semler Scientific to form a major treasury company with more than 10,000 Bitcoin on the balance sheet. For more, we want to bring in here the CEO of Strive, Matt Cole. Matt, it is great to see you. So I'm reading about this is actually one of the biggest all-stock Bitcoin treasury mergers to date. So walk us through the news, Matt, and just the strategic rationale here.
Yeah, so it's actually the first merger of two Bitcoin treasury companies. And so Strive actually just went public ourselves a little over a month ago as a new Bitcoin treasury company. And Semler Scientific was actually the second US Bitcoin treasury company that were publicly listed. And the idea here is a couple different things. One, that when you actually combine the scale, it actually drives down the cost of running a Bitcoin treasury company. And one way to think about a Bitcoin treasury company is effectively on one side an operating company, on the other side effectively a hedge fund that is doing various different things to outperform Bitcoin itself over the long run, which we can get into. It revolves around digital credit and actually a carry trade. And then the other thing is actually reimagining a broader mandate for Semler's operating business and leveraging people like our co-founder Vivek Ramaswamy, other board members that have a lot of expertise around preventative healthcare, biotech, and giving that a broader mandate around preventative healthcare, the MAHA movement, and driving better value for shareholders.
Matt, if I'm an investor, I'm listening to this, why do I want to own a Bitcoin treasury company rather than just Bitcoin?
Yeah, it ultimately comes down to your future predictions on the return of Bitcoin. So if you are a Bitcoin bull, and let's say you think that the future CAGR of Bitcoin is 20% or 30% or 40% or 50%. And as an example, since 2020, the CAGR of Bitcoin has been over 60%. So let's say that is your view. a Bitcoin treasury company has access to leverage, perpetual preferred equity that has no margin, is not callable, that is not accessible to you as an individual, to a fund, and so that carry trade can outperform Bitcoin itself over the long run. And obviously embedded in that is volatility. There's periods that, like late last year, where MicroStrategy, as an example, outperformed Bitcoin drastically. There's also periods like Strategy started their strategy itself in 2020. In 2022 and 2023, they actually had underperformed Bitcoin drastically. Now they've outperformed it by about 10x. And so over the long run, these strategies can work, but they're volatility on volatility.
There are critics of this strategy, right? You've heard Jim Chanos.
Yep.
There's a well-known guy, right? He doesn't have nice things to say about this. I think he calls this financial gibberish, Matt. I mean, you heard that, I'm sure. What do you make of that? What's your response to Mr. Chanos?
Yeah, so I think that there's times where valuations can be stretched, but the thing with both Bitcoin and Bitcoin treasury companies is zooming out. So let me give you an example of Strategy itself. If Strategy was gibberish, then even if Strategy's valuation collapsed to the value of their Bitcoin, or even 20% under their Bitcoin, since they've implemented the strategy, they would have still outperformed Bitcoin itself by multiple X's. And so I think what Jim Chanos was not a fan of was the valuation of Strategy at the time. He put on a short, it's probably worked out well for him. But for the company itself, Strategy, they've outperformed Bitcoin in a sustainable way. So has Metaplanet. Companies that have been all in have long-term outperformance over Bitcoin that I think is already showing itself in a way that is pretty unreversible.
Can I ask you more broadly just about what we're seeing cryptocurrencies here, the pressure some have been in, look at Bitcoin or Ethereum, and what you make of that and what you chalk that up to, macro weakness, folks booking profit, what do you think?
Yeah, so over the last week, there was a large, massive crypto liquidation. It was a $20 billion liquidation. It was multiple times larger than the FTX liquidation. And that was around a hack in Binance around a stablecoin that had cascading liquidations. Really didn't impact many institutions. It also didn't impact probably the average American. Who it really wiped out was the crypto native trader and market maker that many of these people had $10 million, $20 million, $50 million accounts completely wiped out, $20 billion overall. And that has caused problems with liquidity and crypto conditions. It's caused downward momentum. And on top of that, you obviously have some broader macro weakness right now in equity markets. And I think that that's kind of filtering through. But over the long run, as an example for Bitcoin, there is not a single 4-year period in Bitcoin's entire history. So today minus 4 years, yesterday minus 4 years, where there's been a single negative period of return over that time. So again, I think it's that zoom out mentality. And when you zoom out, both Bitcoin and Bitcoin treasury companies can work. But in the short term, it's obviously a volatile market, and that's a market where you need conviction and education.
For sure. Matt, appreciate your time today. Thank you.
Thanks for having me.
Well, Bitcoin is trading lower today. Yahoo Finance market and data editor Jared Blickery breaks down some of the seasonal patterns that drive the cryptocurrency's trading action.
Bitcoin broke out to a new high of 125,000 and change in early October, and it quickly fell back into its old trading range. But guess what? October is historically one of the best months for Bitcoin, so on today's Stocks in Translation, we are taking a look at Bitcoin seasonality and the next potential catalyst for the king of crypto. And just a quick reminder that seasonality refers to those recurring patterns that we typically see year after year. And in this first chart, we're taking a look at each month of the year broken down, and it's 2018 to 2024. Why did we start at 2018? Because that's when we got Bitcoin futures, and that's when Wall Street started taking notice of Bitcoin. If you go back further, you really have a different animal on your hands. But what stands out here is a few really positive months. So that's 18% in July, 11% median in February, and in October, also an 11% median. And I'm using the median instead of the average because that's right in the middle. If I use the average, you tend to get bigger numbers to the top side and then bigger numbers to the downside in the negative realms. But what you're going to notice here too is that after October, November and December, they skew negative. So unlike stocks where you typically get that end of the year rally basically from October through December 31st, not necessarily so in Bitcoin. However, we do have this positive catalyst right ahead of us. And here's another look at the month-by-month breakdown with win percentage. And what really stands out here is October is 86% positive going back to 2018. And that ties February over here, which was also a good month. And it's a bit bigger than July, which was the best month. So odds are working in the bulls' favor here. And one more thing is that if you break it down on a day-by-day basis, I have the entire year here from January 1st to December 31st, and in white is what the map is telling us. That's, again, the median from 2018 to 2024, and the green 2025 year-to-date. We are right now at the period of time when it historically inflects up. And so the middle of October into the first week of November is a very seasonally bullish time of year. And you can see how some of the swings that we've had in this year, and there was some interruptions, albeit with the post-Liberation Day sell-off, a lot of the recent swings have kind of coincided with the map. So things are definitely working in the bulls' favor right now. We'll have to see what comes of that. And let's take a look at what to watch now, because Bitcoin investors should be paying attention to a number of things. First, we have bank custody of Bitcoin and crypto assets that's starting to roll out right now. The SEC gave the green light on that way back in January, but banks have lots of regulators. They tend to move slowly. So many investment advisors have been waiting for the safety of bank custody, so watch out for these press releases from some of the biggest players. Then, number two, the ghost of Mt. Gox still haunting the blockchain. Way back in 2014, the world's largest crypto exchange failed spectacularly, and most of the confiscated coins has been distributed back to the owners, but we're finally up against a hard deadline on Halloween, October 31st. How fitting. There's a small chance that some whales could emerge and dump their new holdings after getting repaid, but that's just a small risk. Then, in the spring of 26, the IRS is rolling out new tax forms to report crypto sales. It's going to be a little bit more of a burden for crypto traders, and there could be a few jitters around tax day, but it's still a pretty small risk. You do have to watch ETF flows because something is definitely going on there. Spot crypto funds have raked in $40 billion so far this year, and any let-up in flows could signal lower crypto demand, which impacts price. And finally, watch the current trading range in Bitcoin, which has been in place since July from roughly 108,000 to the downside to 125,000 to the upside. And remember, Bitcoin is famous for its rug pulls and false breakouts, both to the upside and also to the downside. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
We're wrapping up today's Market Domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.